So now we go into the second part of how we are going to pay for IT investments and how do we measure the impact of IT measurements. So how much does information technology cost? And this is important because all IT funding approaches require knowing how much the cost of IT. And this is tricky because we have two components to it. The first one is capital expenditures, which is the cost of purchasing or building new systems. Capital expenditures, unlike operating expenditures, pay off in future and therefore compete with other immediate investments of the firm. Operating costs are ongoing costs of running IT assets, and this is the lion's share of corporate IT costs. Such costs include salaries, support, licensing fees, maintenance, training users, and ensuring that evolving IT systems can continually talk to each other. Operating expense over IT assets lifetime can easily approach several times the initial cost. And yet, a lot of questions focus on the capital expenditure and ignore the operating expenditure. So the shift to focusing on total cost of getting and running an IT assets over a lifetime is important. And this is like buying a car. You got to consider the upfront plus maintenance costs. So how do you know whether a project, IT project, is going to be worthwhile? And we can use three approaches to judge whether a prospective IT project is likely to be a worthwhile investment. And we're going to use some financial terms, which those of you who have done the finance class would probably know better. The first one is the net present value. And this is the workhorse approach that helps decide whether an IT project is likely to be a sensible investment as its net present value. And this is from your accounting, from your finance. This is a project's benefit minus cost, accounting for time value of money, and time value of money comes into play because a project's costs and benefits can span over multiple years. Net present value appeals to its intuitive simplicity and understandability to managers in any department in a firm. The heuristic, the NPV rule, is simple. Pursue projects with positive NPV and reject those with negative NPV. However, this is dangerous because it cannot directly help choose between two projects if they have different costs. To wisely use your firm's limited capital, you need insight into which IT project would be more valuable to your firm. You can compute each IT project's profitability index from NPV to do such a project-to-project comparison. It allows an apples-to-apples comparison because it represents the value created for each dollar invested. A project with higher profitability index is preferable. Now, here are some problems with NPV. It requires costs and benefits in dollars, both of which can be difficult even when you have a guesstimate. Costs are often underestimated, 50 to 100%. Overlook installation, debugging, training costs. A lot of times looking at getting the project, it's not the implementation and rollout of the project, but post-implementation and usability of the project are difficult to estimate. NPV works well when there is little or no uncertainty in an IT project, and that's kind of hard, does not really exist outside accounting textbooks. And finally, NPV cannot account for intangible costs or benefits. The next way of measuring is called hurdle rate rule, and firms set their own hurdle rate threshold, which is a present percentage return a prospective project must exceed for it to be considered to be sensible. For a project to proceed, its own projected rate or internal rate of return must exceed the firm's predefined hurdle rate. Hurdle rates are set with good intentions to discourage squandering money on poor projects, but they can penalize pursuit of a strategically promising IT project whose benefits are difficult to quantify. And this might actually prevent firms from taking some risks which are not bad, because truly innovative projects can come with a modicum of risk there. And finally, a simpler yardstick is return on investment, which is the percentage of return that your investment in a project pays back. Knowing this number, you can decide whether you're better off spending money that a project rather than other ways you could have spent it. Basically looking at the project's opportunity cost. Firms also use the project's payback period, which is how long it will take to recoup the cost. And this should only be used as a rule of thumb to compare projects that deserve further consideration and weed out ones that will realistically never recover their costs. The downside of this project payoff metrics is that they are more about the price you pay, but not the business value you get. They focus more on recovering an IT project's cost, but not how it or your firm's IT portfolio enhances your firm's competitiveness beyond the payback period. IT projects with highest return on investment are not necessarily ones that advance your firm towards its strategic aspirations. So here are three approaches to corporate IT funding, and we essentially are looking at who is going to foot the bill, right? And the first approach we look at is corporate funding. Basically, this is a firm-wide budget, and who pays for it? The corporate pays for it. It's not each division. Upside is it is simple, encourages ambitious projects, but it also encourages poor business decisions about IT and do more damage sustaining IT budgets in the long run when annual corporate budgeting process subjects IT expenditures to a harsh competition with other corporate spending priorities. It also IT technology, it can be technology driven rather than business driven, with IT managers pursuing technology for technology's sake. So corporate funding of IT is therefore simple and fair, but not accurate. Line functions foot the bill for the other two approaches, which is allocation and chargeback. In allocation, it divvies up IT costs among line functions, and based on sound count, such as the number of user accounts and bills based on them on the count. If a 1,000-person company spends $100,000 on an IT bill, line function of 50 users gets a $5,000 bill. It does not matter that some employees in the line function, like a parking deck attendant, do not even use the system. The departments still foot the bill. Therefore, this is simple, low bookkeeping overheads, but it's unfair because it overlooks usage. Finally, we have the chargeback system that charges line functions for actual usage for IT costs. This approach is fair because your line function is charged for what it uses. It sensitizes managers to how much IT is costing their department. Its downside is huge bookkeeping and it gets complicated to actually measure it. So chargeback is fair and accurate, but not simple. So here we go. Simple, accurate, and fair. You've got to pick 2 out of the 3. It is not possible to get all 3. The sweet spot, which is right here, is really not easy to get or impossible to get. So the business value for IT. Are we getting our money's worth? How do we answer this question? First, we need quantifiable data. This credibly demonstrates information technology's business value. It forces accountability and precise thinking. We also know that short-term operational metrics capture operational impacts, and it measures the IT units against its promise to line functions. And operational impacts are things like increased productivity, operational activity is faster, cheaper, and so it is important. However, these operational metrics must finally feed into either increasing revenue or reducing cost. So today's operational impact will later affect financial impact, and you need to consider both for IT investments. So operational short-term impacts are the stepping stones for IT's financial benefits, and they must come from the non-IT managers in a project's functional domain, must tie directly to a project's business objectives, and focus on business outcomes and not what a project does. This also, the conversation of how IT benefits business outcomes helps information technology folks see their work in the bigger picture of your firm. IT strategy now meets managerial accounting and operations management. So this actually gives them a frame of reference to contextualize IT importance and impact of IT. So, and it's important for non-IT managers to pick the operational lag very carefully. Because there is a lag from the IT investment rollout to actually measuring the operational metric. It is important to look at that. And we must explicitly articulate the project's promise. Are we looking at better, faster, cheaper? What's the unit of measurements? Is it in dollars, percentages, time to impact? And the contribution from non-IT managers should be the operational metric and the appropriate lag where a project's promise is actually measured. The long-term, the financial metrics, essentially is used to gauge the contribution of the whole IT portfolio to your strategic aspirations. Whereas operational metrics could be about a particular IT project, the financial metrics, the long-term impacts bottom line, and you've got to look at the entire IT portfolio. This is where IT strategy meets corporate finance. And so the two types here are, you're going to focus on the changes. You can be backward looking as how previous IT investments affected your firm. And these are operating margins, which is essentially the difference between revenue minus cost, return on invested capital, which is the ratio of change in profit capital invested to generate it, and it closely tracks labor productivity and asset productivity. Or you can be forward looking and how your IT investments strengthen your firm's future potential. And here are some examples of how you can use financial ratios. Tobin's Q, which is your firm's market value, ratio of the firm's market value divided by the replacement value of all assets. If it's +1 or more, it signals the market value of intangibles, example, improved service, consumer appeal, coordination, agility, and it's sensitive to industry standards because it's benchmarked against your competitors. And of course, this is usable for public firms, not private firms or nonprofits. And then we have the profits to earning ratio, which is the ratio of share price and earnings per share. And it signals confidence in future profitable growth. And it's reasonable, you can reasonably attribute it to information technology because a lot of times investments in information technology is about 50% of your asset investments in a company. And there's been quite a good bit of research on IT investments and signaling, the share price to earnings per share ratio, improving that. So the bottom line is that you can argue for a long time about IT's operational impact, such as speedier decisions, more efficiently executed business processes, superior services, customer value, added loyalty, better collaboration. However, they are only means to a financial end, and the end is in creating business value using your people and assets. And so any IT project worth investing in an IT portfolio that it's a part of must improve your firm's financial margins. So here we have some common IT operational impacts and metrics. So let's take examples of better, cheaper, faster, and then we can look at how it impacts your margin. Better employee productivity, and the operational metrics is change in revenue per employee, increases revenue, and it could also decrease costs. Capital asset productivity, better at capital asset productivity, that's improvement, change in return on invested capital, again improves revenue, reduces costs, so increases margin. Better collaboration reduces forecasting errors, therefore improves revenue, reduces margin. Better supply chain management increases your inventory turns, and again that results in improved revenue, reduced cost. Better value added could increase unit selling price, that increases revenue. Better customer loyalty increases the revenue per customer, therefore increases revenue. Here are some other, the next phase of it. Reaching new customers, increasing your customer base, and as you can see the impact there. Ability to enter new markets using information technology investments, that increases revenue and then affects the margin. Creating a new revenue stream which never existed before, again increases in revenue. Reducing IT costs, that decreases IT spending per employee and reduces costs. Better, faster decision making, which will improve revenue and decrease costs. Faster response time, strategic agility increases revenue.